Have you ever wondered what happens to old, nearly vacant shopping malls that seem to have lost their charm and purpose? Well, in Waterloo, Ontario, a fascinating transformation is about to take place that might just answer that question. Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. The Crossroads Mall site in Waterloo is set for a major redevelopment, as reported by Michael Crum from Business Record. This mall, originally constructed in the 1970s, has seen better days. With its anchor stores having vacated years ago, it's now home to just a single pizza shop. The site, sprawling over 57.5 acres, is largely in disrepair, with a deteriorated parking lot overgrown with weeds. The city has partnered with ATI Group of Ankeny to breathe new life into this space. The redevelopment plan envisions a mixed-use district featuring residential spaces, retail outlets, restaurants, and other amenities. BJ Stokesbury, CEO of ATI Group, expressed the project's goal to strategically align with Waterloo's market needs and collaborate closely with city officials to define the vision for this transformation. The mall's property, previously owned by multiple entities including Namdar Realty Group and Dillard's, has seen its assessed value drop significantly from about $13 million in 2022 to nearly $10 million. ATI Group has already begun acquiring parcels of the property, with plans to complete these transactions shortly. The redevelopment is part of Waterloo's 2030 Vision Plan, with Mayor Quentin Hart highlighting the site's potential to become a regional attraction thanks to its proximity to major highways and attractions like the Lost Island Water Park. The city is investing $28 million in a tax increment finance package to support this endeavor. The project is expected to kick off with an asbestos survey and the subsequent demolition of the existing structures, likely beginning in early 2026. According to Stokesbury, the redevelopment aims to create a vibrant community space that could include park areas and possibly an indoor skating rink. The hope is to revitalize the area and create a new economic anchor for the region. This redevelopment mirrors trends seen across North America, where old retail spaces are being repurposed into mixed-use developments. It's a prime example of how commercial real estate is evolving to meet modern demands and preferences. Brookfield is set to sell a half-empty office building located at 3 Bethesda Metro Center in Bethesda, Maryland. This building, situated behind the well-known clock tower, is being marketed for sale, according to a report by Dan Brendel from the Washington Business Journal. The office complex was previously part of a foreclosure auction after the owner defaulted on its loan. This sale is indicative of broader trends in the commercial real estate market, where office spaces are being repurposed or sold off due to changing demand. Brookfield sees potential in converting this office property into apartments, highlighting a trend where commercial spaces are being adapted for residential use to meet the growing demand for housing. This approach aligns with the evolving needs of urban areas where mixed-use developments are increasingly favored. The Bethesda metro area is a prime location, known for its connectivity and proximity to various amenities, making it an attractive prospect for developers looking to capitalize on the area's potential. This sale could pave the way for a significant transformation in the local real estate landscape, similar to redevelopment projects seen in other urban centers across North America, including Kitchener-Waterloo, London, and Cambridge in Ontario, Canada. These changes in the market reflect a shift in the way urban spaces are utilized, with a focus on creating vibrant, multifunctional environments that cater to both residential and commercial needs. The potential conversion of the Bethesda Metro office building into apartments is a clear example of this trend, offering insight into how commercial real estate strategies are evolving on both sides of the border. JLL Capital Markets has announced the successful arrangement of an $83 million sale for the Mandarin Oriental Retail Collection in Boston's prestigious Back Bay neighborhood, as reported by the Boston Real Estate Times. This retail collection, spanning 28,856 square feet, is situated at the base of the Mandarin Oriental Hotel and the Prudential Center, two of Boston's most iconic commercial destinations. With 100 feet of frontage on Boylston Street, the property enjoys exceptional visibility and benefits from high-foot traffic, drawing locals and tourists alike. The sale was facilitated by JLL, representing the seller, and procured by the Hennick Group, a privately held investment company. According to Chris Angelone, Senior Managing Director at JLL, the sale price marked one of the highest price per square foot retail trades in Boston's history, highlighting the asset's exceptional quality and future potential for the Hamoen Group. Strategically located between luxury hotels, residential towers, and major tourist attractions, the Mandarin Oriental Retail Collection benefits from steady consumer foot traffic. The area is adjacent to popular destinations such as Italy, View Boston, Fenway Park, Boston Public Garden, Boston Public Library, and Copley Square. Currently, the property is 82.2% leased, with anchor tenant Citizens Bank occupying a prominent space. Other tenants include luxury linen retailer Fret, beauty brand Minilux, and eyewear boutique Lunette Optic. This high-profile transaction underscores the continued demand for prime urban retail real estate, even amid broader challenges in the commercial property market. It signals renewed investor interest in high-foot traffic, high-income urban corridors, particularly those anchored by luxury and experiential retail. With retail performance in Boston's core neighborhoods showing signs of resilience, the acquisition offers the Hamoen Group an opportunity to enhance the property's prestige and long-term value. D&S Development, a prominent urban infill developer, has decided to list its entitled site at 3000 L Street in East Sacramento for lease or sale. This property, which was originally slated for redevelopment into a 133-room hotel, is now being marketed by Turton Commercial Real Estate, as reported by Ben Vandermeer from the Sacramento Business Journal. This decision comes 4 years after D&S Development acquired the property, reflecting a shift in their strategic focus. The decision to market the East Sacramento site comes amid broader trends in commercial real estate, where developers are reassessing their portfolios to better align with current market demands. This particular site, with its entitlement for hotel use, offers potential for various types of redevelopment, depending on the buyer's vision and market conditions. The East Sacramento site is strategically located, offering easy access to local amenities and transportation networks, which enhances its appeal to potential developers. This move by D&S Development highlights the dynamic nature of the commercial real estate market, where flexibility and adaptability are crucial in responding to changing economic landscapes. In the context of Ontario's commercial real estate landscape, similar trends are observed in regions like Kitchener-Waterloo, London, and Cambridge. Developers in these areas are also exploring mixed-use developments and adaptive reuse projects to meet evolving market needs. This cross-border relevance underscores the interconnected nature of real estate strategies in North America. At the recent BofA Securities 2025 Global Real Estate Conference, Simon Property Group showcased its resilient retail strategy amidst a challenging economic landscape. Simon Property Group reported robust second quarter results, with increased occupancy rates and retail sales driving its strong performance. The company is making significant investments in digital infrastructure to enhance the customer experience. This includes the upcoming launch of the Simon Plus loyalty program, which aims to seamlessly integrate online and in-store shopping experiences, and the Simon Search tool, which allows real-time inventory searches. In terms of financials, Simon Property Group generates over $4.5 billion in funds from operations annually and pays over $3 billion in dividends, yielding about 4.5%. Their second quarter performance saw a 4.2% growth in domestic property net operating income and a 4.7% growth in their overall portfolio. The company is also expanding internationally, having opened a new premium outlet in Jakarta, Indonesia, and is exploring further global investments. Despite facing interest rate headwinds, Simon Property Group remains confident in its financial flexibility and growth prospects. Looking to the future, Simon Property Group is focusing on reinvesting in its assets, growing dividends, and evaluating acquisitions. The company's strategic initiatives underscore its commitment to operational excellence and long-term shareholder value. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.